never buy real estate for the tax benefits. When you buy a single family home, you own part of the land. And if you're owning a property in an area where the land's worth a lot of money, you're not gonna get as much tax benefits for that. I'll tell you right now, realtors lie, brokers lie, a lot of people will lie to you. And so you wanna make sure that you're doing the work that needs to be done. When you're talking about investing in a property that's not in the state that you are located in, especially if it's not in your backyard. Like I know when I was learning about long-term rentals, when I first started getting into like bigger pockets and things like that, it was always about finding properties in your backyard, like where you guys live at. And so normally people are going to be really used to, and they should probably know the laws of where they're living at. When you're talking about investing out of state, it gets really challenging, especially short-term rentals, just because of how quickly and how frequently they change the rules sometimes in certain areas. And so when you're investing out of state, I think there's 4 main things that you want to consider. Now this may not be all inclusive of everything, but this is at least my 4 list. So the first one would be, you really want to hone in on how does that, it's really that municipality, like that city or county, how do they assess property tax, okay? Some states, they will trigger the reassessment after a sale of a property. So let's say I bought a property in October of 2023. Well, come March 2024, I'm getting a bill for whatever the property tax was plus a % increase, right? And as investors, we really want to know what that % increase is, right? So I'm going to get into that. We're going to talk about income tax specifically, income tax in different states. We're going to talk about occupancy taxes a little bit. Man, I cannot write today. And then the last one we'll talk about is state legal issues, something that just got brought up by somebody here. I wanted to kind of touch on this. So property taxes, super important. Here's two reasons why you really want to make sure that you nail property taxes, okay? Especially in states that are left-leaning, more liberal states, or even just cities, like in Austin. A lot of people invest in Austin, Texas, right? Like those property taxes can be mad crazy. Like I've seen $3,000 to $4,000 tax bill jump all the way up to $9,000, $10,000, $11,000, $12,000, right? Like absolutely crazy in some places. Not all states, right? But not just left states. But really want to make sure that you get property taxes down. Okay. Well, how do you do that? So in every single state, I believe except Texas, I'm not sure. Every single state, you should be able to look up what the current owner's property tax bill is. Even if their property is in an LLC, even if the property is owned by a business, you should be able to go online, type in the address of the property, and figure out what the current tax bill is, okay? Not too hard, right? So you just go on, type whatever city you're investing a property in, find their county assessor website, it's called, and you're gonna type in the property information. Now, here's the secret. The tax bill that you see there is not the tax bill that you're going to pay after you buy the property. So what you have to do is you have to figure out, number one, how do they reassess the tax bill? Again, some counties, some states, I don't want to get into it too detailed, but some of them will do just a flat rate of whatever the new purchase price was, right? So they'll do 1% or 0.5% or whatever the purchase price is. Some of them will, who you don't really know what sort of calculation they use, and so you have to almost figure it out or try to baseline it yourself, okay? So what you do is you want to find 3 to 5 comps of properties that have recently sold in that area that have a similar bedroom, similar bathroom count as yours, right? So let's say I want to buy a property on 123 Main Street, and the current property tax bill is $3,000 for that property. Well, my 3 to 5 comps, they all went from $3,000 to $3,500, or they went from $2,700 to $3,200, or they went from whatever the case may be. Let's say across the board, you're looking at 3 to 5 different comps. Typically, preferably within the last year. I mean, if you have to go out 2 years, that's probably fine too. but you're going to find 5 comps and see what percentage their property tax bill went up, because you can see on public record how high their property tax bill was before they bought the property and how high it was after it got reassessed. And you take that percentage and you multiply that across to your property tax bill, right? So let's say the percentage increase was 20%. I can multiply 3,000 by 20%, $600. Add that to the 3,000. So now I can reasonably expect my property tax bill to be 3,600. So when you guys are doing your pro formas, you really want to make sure that you're capturing this $3,600 property tax bill instead of the 3,000, because I'll tell you right now, realtors lie, brokers lie, a lot of people will lie to you, and so you want to make sure that you're doing the work that needs to be done to make sure that you are pretty much not going to get sidetracked whenever the property tax get reassessed. So here's another reason why you would want to do this too, by the way. Depreciation. Okay. So you guys have always heard me say, or you've heard me say, never buy real estate for the tax benefits. But for those of you that are W-2 or that are high income and you really want to save as much money as possible on taxes, where you buy property is super important. Okay. So in real estate, obviously we call that the location. So typically in the Midwest, I would say anywhere but like Cali or Florida, right? New York City, these areas. Actually, there's a direct correlation sometimes between the property tax bill and the lack of depreciation and the lack of tax benefits. So you really want to make sure that where you buy is super important when it comes to tax benefits. So if you are looking in an area like a California or a Florida, it might actually be worthwhile to do a townhome or a condo. Why? Because when you buy a single family home, you own part of the land. And if you're owning a property in an area where the land's worth a lot of money, you're not going to get as much tax benefits for that, right? So the location where you buy the real estate is super important when it comes to maximizing tax benefits. And so again, we don't buy real estate just for the tax benefits, but if that's something you're very interested in and it's going to sway your decision one way or the other, you want to do this exercise, right? Because remember, all this stuff that I'm teaching you guys right here, this stuff you guys can do yourself on the county tax website. So, don't take a realtor's word for it. Don't take the broker. Definitely don't take the listing agent's word for it, right? But this is like public record stuff that you guys can do yourself on the county tax website. So property taxes, number one, we want to make sure that we nail whatever the reassessment's going to be. And then number two, we want to know for depreciation purposes, what sort of tax benefits can we expect to get out of that property? And the only reason why I always bring this up is I had a client in 2022. She bought $1 million property in the Smoky Mountains, right? And it saved her like over $100,000 in taxes. And then the next year she bought $1 million property in Gulf Shores, and for some reason she was expecting the same result. Well, in Gulf Shores, the land can sometimes be worth 50 to 60% of the purchase price in some cases, right? And so she didn't get $100,000 in tax savings. She only got half, if not a quarter, of the tax benefit because of where she bought, right? So location, super important when it comes to real estate. I don't think I need to tell you guys that again. Income tax. So the actual tax on the income that we're talking about. So there's a couple different types of taxes. We're talking about income tax. So this is specifically the income that you pay to a state for owning a property there. So I'm going to use my example because I think I can really portray this pretty well. So let's say I live in Illinois. That's where I am domiciled at. That's where I spend all my time at. So I live in Illinois, but I'm going to go buy a property in Ohio, okay, just to keep it easy. Now, Ohio, because the real estate is physically located in Ohio, I am going to have to pay income tax to Ohio, okay? So let's say I had an Airbnb in Ohio and it made $30,000 a year profit, right? Well, let's say Ohio has a 4% income tax. Okay. So I pay $30,000 times 4%. So I'm paying $1,200 to the state of Ohio. Now, this requires me to file an Ohio, what's called an Ohio non-resident return. So I still have to file in Ohio, but I'm filing as a non-resident, which basically means I don't live there. I have some business activity, I have some rental activity there, but I don't live there. Now, here's what most people miss out, is the fact that all the states have what they call a multi-state tax compact, which basically is you cannot pay state income tax on the same money twice. Okay, so Illinois has a 5% tax rate on all income, but I get a credit for the taxes that I paid to Ohio. So on my Illinois return, and this is going to work out just like on every single one of your returns. On my Illinois return, I'm going to get a $1,200 credit towards my Illinois state income taxes. So it's not like I get double taxed on that. I'm not paying $1,200 to Ohio. I'm not paying whatever it is to Illinois. But if I file that non-resident return in Ohio, and again, here's the key, I actually have to file that return. I can't just make it up and say that I paid those taxes. I file that return with Ohio, and then I can claim those taxes on my Illinois return. So this is how all the states operate. Now, the one time where I would say you're probably going to get the shorter end of the stick is in when you live in a state that has a lower income tax rate, or maybe you live in a state that has a zero income tax rate and you invest in the state that has a higher income tax rate. So like, let's say, for example, let's just say this was California and not Ohio, because I love picking on people from California. This tax rate might be 9 or 10%, okay? So this tax bill, instead of $1,200, this thing's $2,700, right? Now, most states, and I don't want to say all states, but I just know like probably more than half of them, they limit the state credit that you get to whatever your home state's tax rate is. So in other words, if I go and pay California 9%, okay, and I file a non-resident California return, Illinois is only going to give me credit for 5% of that, because that's all I would have been subject to pay if that property was in Illinois. That's kind of how they come about that. But basically, in this scenario, like I lose this $1,500. Like it's just gone. I can't go back to California and claim it, and Illinois isn't giving it to me. So that's actually taxes that I pretty much lost out on. So unfortunately, this is how it goes. So those are state income tax. Now another thing I'll throw in the ring on this is a lot of people will say, oh well, aren't I going to have a loss the first year because of all my expenses, my repairs, bonus depreciation in that state? And the answer is yes. You're probably going to have a loss the first year, which means that you won't have to pay taxes to that state. But here's the thing. A lot of people, because they have a loss, we've seen it in the past where they just decide not to file a state tax return because it's like, okay, well, I'm in a loss. The state, I don't owe the state any money. The state doesn't owe me any money. And can I just not file? Well, you have to file in order to carry forward the state loss. So if I bought a property and let's say I had a $20,000 loss on the property because it's the first year, and I have all these expenses and renovations and things like that, I have to file the return to carry forward the loss until next year. Okay, so let's say I had this 2023 loss, and then in 2024. What if I made $30,000 on the property? Well, I can use this $20,000 loss carry forward to offset the $30,000 that I made in the future. And so now in 2024, I'm only paying taxes on $10,000 of income, right? But I have to file to carry forward that loss. Does that make sense? Okay. So we talked about property tax, we talked about income tax. Now, okay, here's kind of like the stepchild of the room that I really don't want to talk about, but we're going to have to anyway, is occupancy tax. So be really careful on this because in bigger vacation rental markets like your Smokies, your Destins, your 30As, the Airbnb and the platforms are automatically going to withhold these taxes on the income. Okay, and then like you're not even gonna see the money. You know, the guest is gonna pay you before you get your Airbnb payout. They're gonna take that money and give it to the local county. But double check your listing, especially if you're not sure. Like double check your listing on that before you even get your first booking and see what they're actually taking taxes out for. And so then that way you can be prepared, because if your Airbnb or your Vrbo is not taking out taxes, then you're going to have to remit them yourself. And so that's going to require you to like register with your county or city occupancy tax and have them or remit the money to them. So let's say if your occupancy tax rate's 2% and you collect $1,000 of rent, well, you got to remit $20 to your county, and they typically want it monthly too, by the way, or sometimes quarterly, but monthly. And so you have to figure out how to set up the system. Now, there's some providers out there, like if anybody's ever heard of like Avalara or I'm trying to think of the other ones, but they're kind of not coming to me right now. But just double check your listing to make sure that you're remitting occupancy taxes. If not, you're gonna have to send those in, like I said, typically monthly or quarterly. So. State legal issues. Okay. So I'm gonna throw this one out there too. A lot of people think that it's okay to own properties in states with different LLCs. Okay. So for example, like let's go back to my example of me. So I live in Illinois and I have a property in Ohio. Now, I do have an Illinois LLC holding company, but this doesn't own the Ohio property directly. You don't want to do that. I can have my Illinois LLC own my Ohio LLC, and then the Ohio LLC is the one that actually owns the property, right? But you never want to have a different state LLC own the property directly. Does that make sense? So because if I go to court in Ohio and I have an Illinois LLC, they could like not let me go to court because I'm not actually doing business there. And then it requires you to register out of state, et cetera, et cetera. And so you always own real estate with an LLC in the state that the property is located at. Okay, and so this sort of structure right here, I can replicate this to any state. Like let's say I bought a property in Florida, okay? I got a Florida LLC, and these are all gonna be single member LLCs, by the way. I got a Florida LLC that owns the Florida property, and then that Florida LLC is owned by my Illinois LLC, something like that. But I'm not owning the Florida property directly with my Illinois LLC, okay? Let's say I wanted to buy something in North Carolina. I got a North Carolina LLC that owns the property. And that North Carolina LLC, here's what I think I left out. That North Carolina LLC, all of these are owned, the single member in all these LLCs is my holding company, is my Illinois holding company, okay? And so what's really cool about this, especially if this is a single member LLC, all these are single member LLCs, I don't have to file any tax returns for these. Everything flows up to my personal 1040, my personal tax return. Okay? So that is going to include, or I guess that includes the state income tax stuff to watch out for.